we think about the change in the rate environment, it really has turned something that was a tailwind for REIT markets and real estate values into more of a headwind. It causes us to dig deeper into the balance sheet structures of the REITs that we invest in, make sure they have appropriate levels of leverage, that they utilize largely fixed rate borrowings, and that they have multiple access points to debt and equity capital.
Joining me today is Brian Jones, Managing Director and Portfolio Manager with Neuberger Berman. Brian, thank you so much for joining us.
Great to be here.
Now, here at REITwise, you were on a panel looking at the state of the capital markets. How has your investment philosophy shifted in a world with higher interest rates?
Yes, so that's been a significant change recently. We've been through a period of low interest rates for almost as long as we can remember. And so higher interest rates obviously have a profound impact on real estate capital markets and on REITs themselves. So principally the cost to finance acquisitions, the cost of interest rates in their income statement. Higher interest rates can also pressure asset prices broadly. So when we think about the change in the rate environment, it really has turned something that was a tailwind for REIT markets and real estate values into more of a headwind. It causes us to dig deeper into the balance sheet structures of the REITs that we invest in, make sure they have appropriate levels of leverage, that they utilize largely fixed rate borrowings, and that they have multiple access points to debt and equity capital, so that if in periods where debt capital markets are too expensive or even closed to some degree, REITs can continue to maintain their capital structures until there's better financing opportunities. So in a sense, we're battening down the hatches in terms of how we look at balance sheets and capital wherewithal.
And as an equity REIT investor, how do you incorporate the current inflation outlook into your decision to overweight or underweight either a property type, a geography, or even a specific company?
So inflation is generally a positive trend for real estate in terms of the ability of landlords to capture higher inflation in the form of higher rental rates. When we think about inflation, we think about it as the tension between the supply of a real estate subsector and the demand from tenants for space in those subsectors. And so we think of the sectors with the best inflationary tensions are the ones with the strongest tenant demand relative to the supply of real estate. And so the sectors that have really stood out recently in terms of demand tension have been industrial warehouses driven by the growth of e-commerce. The residential sectors have benefited recently as interest rates have risen. The cost of home ownership to own a single family home or a condominium has escalated significantly, and that serves as a tailwind for residential REITs. And then the final sector I'd mention would be self-storage. And here, the work from home environment has caused people to declutter their homes, and that's been an additional demand driver for the self-storage sector. So those sectors stand out in terms of their ability and the strength of the inflationary pull in their sectors. But one of the other things we consider is inflation's impact on expense trends for REITs. And here, we're really looking for sectors where the labor intensity is lower at the property level. So if you think about a warehouse or a self-storage facility, the number of workers employed by the REIT at the property level is pretty low in those instances. And so those sectors can drive the top line rental rate growth all the way through to bottom line earnings. So we're thinking about inflation from both a top and bottom line impacts scenario.
And finally, when you're evaluating individual companies, how much weight do you place on environmental or social criteria?
That's an evolving area for us. We've always looked at governance in terms of evaluating REITs, in terms of how their governance structures are, whether all shareholders are treated fairly, how managements compensate themselves. But more recently, the environmental and social concerns have risen in importance. If you think about environmental as an example, we're seeing local states and municipalities enforce greenhouse gas limits in terms of the emissions from office buildings or apartment buildings. And this has profound impacts on the cost of owning older, less efficient real estate assets. So it's something we consider. And then on the positive side, we're seeing within the office and the warehouse sector to a degree, tenants preferring buildings that have better green bona fides. So either lower emissions or solar generation at the asset level. These types of attributes are driving tenants to certain assets. So that's becoming more important. And then on the social side, we just think that REITs should reflect the broader country in terms of their demographic profile and gender positions. If you think about a lot of different REIT sectors, retail, the primary shopper there is a female shopper. So why wouldn't a REIT have significant exposure on their board and in their management team to women? If you think about hotels or industrial warehouses, the workers in those buildings tend to be either black or brown in many instances, and so it would make sense for them to be represented in the corporate structures as well.